Welcome back in, everybody. So in this video, we're going to go through a bunch of different stocks, specific sectors that I actually think are on sale that we could take a look at here. So let's just get right into it, guys. If you like this type of analysis, my name is Colton. We do fundamental analysis on this channel. Welcome into Compounding Capital. So as we projected on this channel, we did say that we were going to hit newer highs after the recent sell-off from the Fed's meeting, stating that they were cutting rates by 50 basis points. We got that euphoric tick, and I said right around 575 we would possibly tap out. Well, we hit 572 intraday. I'm going to zoom in right on this level here, kind of just talk through what I'm seeing before we get into individual stocks from a fundamental perspective here. Now, of course, this is just my opinion, ladies and gentlemen, so take it with a grain of salt. But what ended up happening here is we did close above this trend line that was been in place since the October lows. We've been inside this channel here that's been a multi-year channel. This yellow line is the multi-year channel. This white line is October low trend line that I've drawn, and we can see here that we're hitting basically an 8 and a 9 count, which to me is signaling that maybe this market's getting a little exhausted here. Maybe we only have a little bit of a move here, but I do think we're starting to put in a top in this market, meaning when we look at valuation and we think about all the catalysts that can possibly come, in my personal opinion, I believe the catalysts are actually to the downside than they are to the upside. When we think about two land wars going on, a presidential election that's getting a little crazy here, and we think about valuations pushing 30 times earnings, a lot of things to me are pushing more to a downside move in this market. Now, if we were trading at 22 times earnings, there wasn't two land wars going on, yeah, I could definitely get behind maybe a bullish case on valuations with 10-15% growth rates going into next year, but I just don't know if these growth rates are really sustainable. I think most of what's taking place in our economy has been based on consumers being well capitalized and all consumption. We don't produce anything. And so when we look at things like ISM, leading indicators, I definitely think we have some problems when we think longer term in this market here. You know, ridicule it, but I've been pretty accurate here. We definitely called this move right here. And I would be looking at anytime we get into the 570s, 575 maybe, to possibly start taking profits. I do think we'll probably tap out at the highest just below 6,000. As we start heading into October, I do think this is going to be a higher risk period, and we're only a few weeks away from where I think we're going to start seeing some higher risk periods, not positive catalysts to kind of keep pushing this market forward. We kind of have to think here, what's been moving the markets up is getting inflation under control, has been a strong labor market, but at some point in time, we have to look at valuation and say to ourselves, what are we paying for these stocks? And when we look across the broader sectors, it's still getting pretty expensive. Now, you can find a handful of names that I think are pretty reasonable, and obviously small caps are pretty interesting. But when we look at the market as a whole, there has to be some sort of turn or correction that takes place here. I just think valuation's getting a little ridiculous when we look at what positive catalysts can come here. Are we really going to grow earnings by over 20% next year? Probably not, which then means that the market historically is trading pretty expensive. And then when we think all the bad stuff that can happen, in my opinion, I think the bad stuff definitely outweighs the good stuff. Credit spreads widening, a lot of different things in the financial aspects could actually go the wrong direction here, but that doesn't mean that we can't hit newer highs. As we look at the market here, it's definitely still in positive configuration. But what I want to point out is, you know, when we look at the RSI, we definitely can go a little bit higher, but it's starting to roll over here with money flow. And then when we take it down to the McClellan oscillator, we're starting to get a divergence on the McClellan oscillator, which might mean that a top is coming in place. As you guys can see here, the McClellan oscillator is starting to point down. We hit a double top on the McClellan oscillator, and the stochastic is still pointing up, but I imagine that might start rolling over here pretty soon. So when we compare that to what's going on, we basically take a newer high on the market, but when we go down to the McClellan oscillator is diverging from that, as we can see here, as it's pointing down. This white line is pointing down. So the market internals are telling us that maybe we're starting to reach a correction period, a topping process, which is now lining up, as I stated, for basically the beginning of October to mid-October is where I think we start seeing froth. So that was just my quick dive into what I think is taking place in the overall S&P 500. But let's talk about maybe some opportunities that are out there for everybody. So the first thing I want to point out here is FedEx is down 14% on the day. Now, this is based off of a slowdown in the economy that they're starting to see here. Not as many priority mailing packages being done, which tells me that, number one, the consumer might not be spending as much as we all anticipated when it comes to holiday season, if they're starting to see this now. And number two is, I'm guessing there's not as much business transactions taking place either. These are two companies that I actually think are pretty interesting if we see a pretty significant sell-off when we go into recession. These are type of companies that I think can actually outperform coming out of recession, and you're also looking at pretty nice dividend yields as well. But to give you guys a jumping off point of where I think we need to be looking at something like UPS, I have a price target of 113. With dividends reinvested, this should give you a double-digit rate of return if they can grow around 3 to 4%. So that's kind of where I have UPS. Now they're dealing with their own problems as well. And so when we look at this recent sell-off and that they're going to be reporting earnings probably in the near future, it's probably going to be a similar situation here to what we're going to see from FedEx. FedEx is selling off 15%. I don't think UPS has as good as management as FedEx, so I do think we could see a significant sell-off in UPS, which could lend a buying opportunity possibly here. So just wanted to kind of point that out and tell you guys where I stood on that one as well. Now, I want to talk about a stock that's always been interesting to me, but I've missed. I think I've missed not because of valuation, but this just seems to be a popular stock with retail investors, driving the price really, to me, to be kind of not outlandish, but definitely a rich valuation here. Now, Pinterest to me is a pretty interesting setup here. $20 billion market cap. I definitely think it has a nice footprint in the social media platform. The engagement that's on this platform is pretty interesting as well. It really touches the heartstrings of the individuals that go on there. And it definitely brings a positive interest into social media that I think is kind of unmatched. And so when I look at Pinterest here trading at 104 times forward earnings, now this is a company that has great management in place. We're basically betting on management to execute when we're buying at these levels. But the one thing I do want to point out is top line revenue growth has been very, very strong on this company. We go back 4 years. This was a company doing 1.6 billion in revenue. Now it has doubled to 3.3 billion in revenue. And I want to make it clear that this to me was always a interesting stock that I just could never get into. But we're going to update this one live with you guys here, as I do have, here it is. I do have a price analysis on this one. To me, I thought this was a mature company at $40 a share, and this stock hit $40 a share before I could even get into it. I had an ideal price target between basically $13 and $16 a share, and that's using 11, 9, and 5% growth rates, as I do think growth rates were going to slow down here. As you guys can see here, I'm not far off on the revenue. I did this analysis a long time ago. I thought they were going to do right around 3.3 billion in revenue, and take a look at this. We're right on it, guys. 3.338. So missed it by a few million. Not too bad because I do build safety in my analysis. I think next year they'll do right around 3.6 billion. So let's take a look and see maybe where I'm missing the opportunity on Pinterest here. Forecasters have a low of $32 a share, a high of 52. And we can see here that where I'm missing the opportunity possibly could be the growth rates on top line revenue. Along with that, it looks like earnings are going to grow exponentially here. So more efficiency in the business, maybe more stock buybacks, but we can see that where I'm really missing the opportunity, or where I could be wrong here, is definitely that top line revenue growth, growing a much more faster than I anticipated. So if we're thinking about closer to maybe 12, 13% growth rates, then let's go back to the drawing board here and see what we come up with. Now, first thing I want to do is, because this is an older chart, I want to update the dates on this, make it going for next year. So we're thinking futuristically here. We want to go earnings for 2025 and beyond. So 2025, 2026, and so on. So where are they projected to do for 2025? 2025, they're projecting right around 4 billion in revenue. I'm going to build just a little bit of safety here and get it to maybe 4.1, 3.9, somewhere in that ballpark is kind of where I want to build for off of 2025 here. The other thing I want to do here is just update their balance sheet. They have 2.5 billion in cash equivalents. Net debt is sitting at 196 million. Super clean balance sheet here. So when we update our analysis on Pinterest, I think anything between $15 to $20 is in the wheelhouse at this point in time. So we did get a nice bump on valuation due to the fact that they are maintaining growth rates here. The balance sheet is still very clean. A lot of things to actually like about this stock, and I believe that's where we start seeing in value territory here. And if we kind of just do some quick paper math on forecast, in 2025, they're projected right around $1.80 of earnings. When we compare them to the peers that are trading around 18 to call it 20 times earnings, and we take a look at the growth rate, they're outgrowing their peers. So obviously we could put a premium on this, and I think a 20 multiple does make sense for Pinterest here. So just doing some paper math here, if we use that $1.80 of earnings, we put a 20 multiple on that. For a company that's growing, between 10 to 15% is very, very reasonable. So if we have a $1.80 of earnings, we put a 20 multiple on that, you're looking at a $36 stock. So you're probably asking yourself, why is mine so far off? Because I'm putting a heck of a buffer in there, looking for double-digit rate of return as well. So if I knock my 13% rate of return, I think this is a more stabilized business. I'm looking for a lesser rate of return. Yeah, I think $25 makes more sense. So as we can see here, we got multiple prices, and where the stock is trading, is it reasonable that this thing can get closer to 25, maybe $20 a share? I think it could definitely happen here, and this definitely becomes an interesting add to my portfolio. For me personally, this is a company that I think is still has a long runway to grow. I like the management. I like how they're positioned versus other platforms. I think they're uniquely positioned. So this is definitely one that I think I might add into pretty soon here. Now, with the consumer shifting away from beer products, Molson Coors has absolutely fallen off of a cliff here. As you guys can see, this was pushing a $70 stock not too long ago, now trading around $54 a share. And as we can see here, hit a low of nearly $49. When I look at the forward PE sitting at 9 times earnings, we kind of compare that to industry standard here. So when we compare valuations to industry standard, we can see that Molson Coors is really trading for a substantial discount, 50% off to basically its peers. And from a price to free cash flow standpoint, looking pretty cheap as well, and has an above average dividend yield when we compare them to their peers. Now, this is a company that's still growing in the mid single digits. Where this was one that I did an analysis on. Unfortunately, I can't find it, so I have to rerun this analysis, but I believe right around $46 to $45 was an ideal price target. Don't quote me, but I believe that's where we come in at. The payout ratio is only sitting at 27%, which means that they do have that ability to reinvest. They're not too tied to that dividend. So this is one I'm definitely adding to my watch list around that $45 mark. As you guys can see here, they're projected to do nearly $6 of earnings. I'm even going to cut that down to $5 and just say they have an awful year. They do $5 of earnings. Now, if we just put a 9.5 multiple on that, we're basically looking at $47.50. But here's the crazy thing. If they do $5 worth of earnings, but it gets multiple expansion and gets closer to what the peers are trading for, maybe closer to 16, 17 times earnings, we're looking at an $80 stock here. So when I look at the risk versus reward on Molson Coors here, I don't think there's that much downside risk. Maybe it gets into the high 30s. But when we think about what is the upside here, if they can accomplish $6 of earnings and they can get some multiple expansion here, maybe trading at closer to 15 times earnings, we're looking at a $90 stock. Now, if we buy it at those if we buy it at those depressed levels around $40 to maybe $45, not only do we have 100% upside in basically a short period of time here, but we also have a pretty nice dividend yield to reinvest in as well. So this was one that was actually starting to get pretty interesting as it keeps selling off to me. Now, when you think about Molson Coors, you're probably just thinking about Coors Light, but they own a lot of brands here. Obviously, Coors Light, they have Coors Seltzer now, Foster's, Lioncoughl, Miller. They also own Peroni, which is one of my favorite beers as well. So they own a lot of beers that I personally like. And then when I look at valuation, it seems extremely reasonable here with a 3% dividend yield. Well, guys, I think that's all I have for you today. If you have any questions or comments, definitely leave them down below. Always appreciate everybody coming in, smashing the thumbs up for me, and subscribing to the channel. And as always, guys, we will see you in the next one.